As dust settles on the Eurozone crisis, there is less talk of struggling economies threatening to unravel the single currency. The questions of today are no longer about whether Greece or any other member will exit the euro, but how and when they will exit their rescue programs with the so-called Troika of international lenders, the European Commission, European Central Bank and International Monetary Fund.
The exit from financial assistance needs to be managed well. Countries have achieved a lot, and therefore also market sentiment has become more positive towards some of the countries. At the same time, vulnerabilities are very high. We still have very high debt levels, both in the public and in the private sector, but there are also significant achievements such as a reduction in the deficit, a reduction in the current account deficits. So the picture is a mixed one, and so it is very important to carefully study which country should exit, under what kind of conditions. Should countries exit cleanly, meaning basically without any further financial assistance, or should they exit with access to a flexible credit line, or should they actually stay on a program and get another program?
Ireland recently became the first to cut loose from EU aid.
One could debate whether or not it would have made sense for Ireland to actually draw on a flexible credit line, so on a precautionary program. The decision was not to do it, but still I think there are significant risks despite significant cash buffers on which the Irish government is sitting.
The question now is whether other countries under aid programs will be discharged in quite the same way.
The three remaining countries under assistance, Portugal, Cyprus and Greece, cautious optimism is warranted. Last week, Portugal successfully issued a 5-year bond at reasonable interest rates.
Portugal is next to make its final repayments in May, and some suspect the Troika might devise a more cushioned exit for the still fragile economy.
There's been much progress. Nonetheless, it's still a weak economy, a structurally weak economy. And therefore, given its high debt level and its high external debt level, it may be slightly dangerous to have a clean exit. So we would much prefer that it exited with a precautionary program that would insulate it from vagaries of problems that could occur. It is an economy which has structural problems, and I think everyone recognizes that Portugal needs to continue what is already done during the program is structural reforms. It really needs to modernize its economy. It has potential, but some of those reforms, clearly, they will take time to be implemented. So I think markets will need to see that indeed Portugal is on a safe path towards higher growth than what it had before the crisis. And what it certainly has compared to the situation before the crisis, that it has much higher level of debt. So if it had to have still the low growth potential that it had before the crisis, then I think it would be in a dangerous zone. High debt, low growth, that doesn't sound too good. But high debt and better growth prospect, which would come with structural reform, then that would put it on a safe path.
But the real concern that remains is Greece. The country was handed a €110 billion bailout package from the Troika over the last 4 years and has met many EU demands to carry out public reforms. But high unemployment and slow economic growth have dimmed the country's prospects of leaving financial assistance anytime soon.
In Greece, the continued political turbulence and the unfortunate lack of national unity weakened the drive of structural reforms, especially in the first 2 years of the implementation of the program, which had a negative impact on economic growth.
Greece has a very high public debt, the highest in the European Union, and also suffered massive economic losses, still has very high unemployment, some political uncertainty. So it's not very likely that Greece will be able to borrow at an affordable rate from the markets, and still there is a financing gap in the next few years. So if there is no market borrowing at a reasonable rate, then Greece would need to have a third program to finance the budget deficit.
But if Greece is unable to kickstart its economy and its debt trajectory develops a runaway path, member states might be forced to rethink their lending approach.
The Eurogroup should help Greece if Greece delivers on its commitments in structural reforms and fiscal adjustment, and the help could take the form of zero interest rate lending, because, for example, from now in the next 20 years, Greece is expected to pay more than 100 billion euros of interest to European partners, and if this interest is reduced to zero, even if not in the full period, but at a time when negative shocks come, this could help Greece to regain public debt sustainability.
Cyprus, the last Euro member to enter a Troika program, remains stable, but the jury remains out as to how well a direct cash injection into its banking system is working. Meanwhile, a Euro-wide banking union is under construction, and the Troika, as it operates today, may also require a revamp.
Going forward, we think the Troika needs to change substantially. First of all, the IMF is not needed to the same extent as it was needed before, because global financial stability concerns are far less relevant now. Second, the European institutions should come with one voice, with a European monetary fund, on the one hand providing money, providing financial assistance, on the other hand asking countries to reform. Finally, the European Central Bank should play a smaller role, because of course there are potential conflicts of interest.
Despite its changing nature, institutional support for the Eurozone's still fragile periphery is set to stay as part of a concerted effort to trigger much-needed economic growth.